Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host Desmond, and today we're turning our focus to one of the world's largest economies, China. With China's economic growth falling short of expectations, the ripple effects are being felt worldwide. In this episode, we'll discuss the reasons behind the slowdown, its global impact, the Chinese government's response, the long-term outlook, and potential trading opportunities in these challenging times. Let's dive in. China's economy, once known for its consistent double-digit growth, has recently failed to meet its ambitious growth targets. Key economic indicators such as industrial production, retail sales, and exports have shown sluggish performance. Factors contributing to this slowdown include 1. Weakened export demand. Global demand for Chinese goods has decreased, partly due to rising geopolitical tensions and slowing economies in key trade partners like the US and Europe. 2. Property sector crisis. The real estate sector, a significant contributor to China's GDP, has been under stress, with major developers struggling with debt and declining property sales. 3. Domestic consumption challenges. Consumer confidence has taken a hit, impacting retail sales and overall economic activity. China's economic challenges are creating headwinds for both its domestic market and the global economy. China's slowdown has far-reaching implications for global trade. 1. Supply chain disruptions. As the world's manufacturing hub, a slowdown in China affects supply chains for industries like electronics, automotive, and textiles. 2. Commodity demand. China is a major importer of commodities like oil, iron ore, and copper. Weaker demand has led to lower prices affecting commodity exporting nations such as Australia, Brazil, and Canada. 3. Global trade volumes. Reduced Chinese imports mean fewer goods flowing through major trade routes, impacting shipping and logistics sectors. The interconnected nature of the global economy means that China's slowdown is a challenge not just for its neighbors but for markets worldwide. In response to the economic slowdown, the Chinese government has rolled out several policy measures aimed at stabilizing growth. These include 1. Monetary easing. The People's Bank of China has reduced interest rates and lowered reserve requirements for banks to encourage lending and investment. 2. Stimulus spending. The government has increased infrastructure spending, focusing on projects like transportation and renewable energy to boost economic activity. 3. Support for the property sector. Measures such as relaxed mortgage requirements and financial support for struggling developers are aimed at stabilizing the real estate market. While these actions show the government's commitment to tackling the slowdown, their effectiveness remains uncertain, particularly in the face of structural challenges. Looking ahead, China's long-term economic outlook presents both challenges and opportunities. 1. Structural reforms needed. China needs to shift from an export and investment-driven economy to one fueled by domestic consumption and innovation. 2. Demographic challenges. An aging population and shrinking workforce could weigh on long-term growth unless offset by productivity gains. 3. Tech innovation. China's focus on becoming a leader in technologies like AI, semiconductors, and green energy could drive future growth provided it can navigate global competition and restrictions. While the road ahead is uncertain, China's position as a major economic power means it will remain a critical player in global markets. For traders and investors, China's economic slowdown presents a mix of risks and opportunities. 1. Commodities. Lower Chinese demand may put pressure on commodity prices. Traders could consider short positions on metals or oil, but should watch for signs of policy-driven rebounds. 2. Emerging markets. Countries less reliant on Chinese demand or those benefiting from supply chain diversification might offer growth opportunities. Keep an eye on markets like Vietnam or India. 3. ETFs and funds. Investors looking for broad exposure might consider ETFs focusing on regions or sectors benefiting from China's policy shifts or global trade adjustments. And that wraps up today's episode on China's economic slowdown, navigating headwinds. While China faces significant challenges, understanding its economic dynamics and government responses can help traders identify opportunities and navigate risks in the global markets. Thanks for tuning in. And in the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, stay informed and stay tuned.